I'm selling off a rental property next year, so I thought I'd make a quick video explaining how I made the decision of selling the property instead of keeping it. First thing we need to do is figure out how much the property is worth. So we have Redfin app opened up. We're going to do a search of properties that were sold in the area. Now the rental property we're talking about isn't actually from Yonkers, New York, but I'm using it as an example. In your particular case, just type in the location of your property. Next, we go into filters. We're going to check sold properties. We want to make sure it's recent, so last 3 months. We keep a nice wide price range, and we want to select properties that are similar to our property. So, I want to make sure there's at least 2 bedrooms, 2, maybe 3 bathrooms, and for my example, it's a multifamily property. There's 3 units, so we're going to click on multifamily and do a search. Now you want to find properties that are very close by to your property and are pretty similar. Find like a handful, maybe 3 to 5. Filter out the lowest price ones and the highest price ones, and you're going to be ballpark close to what your property's value is. You have to account for the condition of the property and things like that. In our particular example, our property's worth approximately $900,000, maybe $925,000. So we're going to use that for the example. On a side note, you also want to consider what time of year you're selling your property at, because prices kind of tend to fluctuate in certain ways. So we have Redfin pulled up here. We've typed in Westchester County, New York, which is where Yonkers is for the example. And we're going to look at median sale price because that's what we care about. You'll see that prices are highest in June and July. So that's when I'm looking to sell as well. People tend to kind of just flock at the same time, and they're just willing to pay higher prices at certain times of the year. Next up, we have to look up the mortgage balance at the time of sale. In this example, we owe $475,000 on the property, or will in June. So if we subtract the sale price and the mortgage price, we get a net of $450,000. So that's how much we'll be walking away with. Actually, that thought process is wrong. So we have to account for all kinds of fees and closing costs that are associated. These fees can vary by area. In our example, we're using 10% of the sale price. So that's around 6% for the realtors and an additional 4% for miscellaneous closing costs. What you'll see is whenever there's an opportunity to make money, other people are also interested in taking some of it. And the final thing we have to account for is taxes. For this, you can consult a CPA. The general idea is you want to subtract your sale price from the original purchase price. In this case was $590,000. You want to subtract out all the closing costs and fees. And then after that, you apply your federal and state tax rate. In this case, it's around like 20% or so total, which rounds out to about $50,000. This puts us at $307,000 as the amount to walk away with. So this is the dollar figure that we need to use to figure out if we should keep it or sell the property and invest in stocks. If you're going to keep the property, we should account for the monthly cash flow. So that's essentially the money that's left over after all expenses are paid for. So we start with the income. In this case, we have rent and laundry. This totals $48.50 a month. From that, we need to subtract out the cost of the mortgage, $3,628. The next category is repairs, and here we're including a large bundle of different expenses into repairs. So for example, if your tenant sends you a message that their sink, for example, is broken and you need to repair it, that's considered a repair. In this category, I'm also including things like utilities, so if you have to pay for water, sewer, garbage, capital expenditures, so if your water heater breaks or your roof goes out, those are included in this category too. I've owned the property for the last 6 years, so I essentially summed up all the non-mortgage expenses. To my complete shock, we've spent $130,000 in the last 6 years on these various repairs. That averages to about $2,200 a month. And I guess I just chalk it up to being a good landlord or just buying an old house. That comes out to a monthly negative cash flow of $878 a month. Although the cash flow here is negative, I would almost consider it a wash because one thing I glazed over is that The mortgage payment also includes principal pay down. Now hold on, you might be saying, why would you ever keep such a property? And that's actually a good question, but cash flow isn't everything. We also have to account for appreciation. Due to the lack of supply that we have of housing, the prices generally go up. What I've done here is plotted out the value of the property, assuming 2% increase in value, and that comes out to an increase of $96,000 over a span of 5 years. The alternative would be to sell the property and then invest in the S&P 500. And we're assuming an increase of about 6% per year. I believe this is conservative based on historical performance. Of course, these numbers aren't guaranteed. And in our example here, if we held for 5 years, the difference would be about $104,000 in a 5-year span. So when you sit down and look at it, keeping the property is almost identical, if not slightly better, than selling the property and buying stocks. There's also other benefits that I haven't brought up, such as tax deductions through depreciation. But because both scenarios are so similar to each other, I've decided to kind of just get rid of the headache, not have to deal with repairs, and sell the property. If you do this analysis yourself, you may come up with a completely different conclusion. But I did want to share this in case it's helpful to someone else out there making a decision. With that, we'll see you on the next one.